But we have Brian on the set with us as we speak. So why don't we get right to him and begin this conversation, get the mood of what's really happening here, Brian. It's nice to see you.
It's good to see you, Andrew. It's a beautiful setting, and you can hear the bells ringing.
It's windy. Yeah. It's windy, and things may go down. That's the only thing we should worry about. I've already been to one dinner. There seems to be, I hate to say it, a lot of pessimism, a lot of sense that inflation is not transitory and that this is going to be extended and prolonged. What are you seeing in the last couple of weeks in terms of at the bank, in terms of bank account balances? What are you seeing now?
Well, what we're seeing is, more importantly, the balances continue to be stable and continue to grow year over year for the broad base of consumers. More importantly, the spending levels in May through the first few weeks are up 10% over last May. And that is not as high as it would otherwise be because last May people paid taxes, so it actually is a bigger base to grow from. So year to date, they're up 17%, fairly stable in May. They're probably up 17%. The consumers continue to spend. In the balances of our customers, they have more money. In April, their balances grew over March. In March, they grew over all the way back to mid last year. So the notion that people are spending the stimulus down isn't happening yet. It may happen, but it hasn't happened yet.
Right. So I was going to say, we hear anecdotal reports. There's some high-frequency folks who are looking at things who have tried to suggest that the last 2 or 3 weeks, bank balances have started, instead of rising, to start to come down. Is that not the case?
It'll happen because people are paying their taxes. And so the reason why California has a big surplus, a lot of tax we pay, and the U.S. government's having big receipts. So you're seeing, especially among more affluent customers, frankly, than the broader customers, people paying a lot of taxes. And that happened in April. You saw the balances go down a little bit. But that's the normal pattern year to year. People will overread that and not really understand that every year, this quarter, because in the month of April, everybody sends a bunch of money to the government, and the government survives off it and does good things with it. But that's what's happening. Generally stated, though, if you compare this April to last April, it's up 8%. Okay. In this May to last May, it's still up 8%.
The other data point that you always have for us, though, is mortgages. What are you seeing there in terms of people's interest, or are people starting to pull back a little?
Well, mortgages have slowed down because, frankly, the refi thing drops away, right? And so our Bank of America Institute just put out a paper the other day from Candace Browning-Platt and the team. And what people have to realize about mortgages is all the fixed-rate mortgages, which are the dominant part of them, don't change rates because rates go up. What the impact is on future mortgages. So will people buy houses or be able to buy as big a house? The reality is 200 basis point mortgage rise on a $300,000 house is $500 a month. The question is, if you make $100,000, you got a 6% income rise, it's the same amount of money. And so what's different than this time when the rates rose in the 17, 18, 19 framework is that wages are rising 3 times what they're rising back then, so people can keep up with. It's going to be interesting, that tug of war. Right now, they slow down all on the refi. The house purchases are still going through.
So all of this says what to you about this larger conversation that we're having now about our economy?
So there's a lot of fear and worry about the Fed tightening, and the Fed will slow down the economy. That is what they're going to do. And so our economists have this year predicted everybody keeps moving. As the Fed has said, they're going to raise rates faster. Everybody keeps moving their estimates down. Our economists said Friday there's a one-third chance of recession. Those numbers get overquoted. If you would have asked them in the middle of 17, 18, they'd have said there's a 15 to 20% chance of recession when nobody had it on their mind. The reality is it's moved up. It's moved up because the government has to slow down and take on inflation. Inflation, you said transitory. It wasn't transitory last fall, and that's what everybody was figuring out. Now they've got to move fast. They moved 50. Last meeting, they expect to move 52 meetings. That is an unprecedented fast rate. The question is, can they slow it down without tipping it over? And that's what the debate's about. People get up in the morning on one side of the bed, said it's going to tip over. People on the other side of the bed said we'll be fine. Our team believes we'll grow this year and next year. And by the way, if you look at all the blue chip economists, only 1 out of like 40 economists has a negative number this year, and nobody has one next year. And if you look at all the big firms, none of them have a negative quarter. So something is this, the probability is rising, the fear is going up, but the reality is no one's really saying there'll be a recession in 22 or 23 yet. We'll see what happens.
What is Brian Moynihan saying?
We think the economy will slow down, but with this kind of spending and this kind of activity, the Fed has a tough job. And this kind of employment tightness, the Fed has a tough job, but it's a job they're getting after much faster than they've done before, and we'll have to see if they can get the balance right.
Becky's got a question back in New York. Bex?
Hey, thanks, Andrew. Brian, I see today that you are raising your minimum wage to $22 from the $21 it had been. This all kind of plays into it. People are having a tougher time keeping up with the costs that are rising, everything from gasoline prices to food prices, and it's great to see that. But it also comes into this whole wage inflation spiral that you see what's going on. Why do you feel the need to raise wages? What does this mean for your employee base? And then how does that kind of fit into the broader picture of inflation, too?
So, Becky, today we had a pattern going from, we announced from 20 to 25 in the year 20 to 25, $1 each year. We moved it up and announced that today from what was going to be October to June. But importantly, last week we also announced for everybody making less than $100,000 in our company, we increased our wages by 3%, 5%, 7%. Based on the years of service. So what we're really trying to do is say we need the best team to serve our clients, and we're trying to make sure that we make our teammates feel great about working at our company and it's a career. So with a $22 start wage, it's fairly straightforward. You get $45,000 a year. If you're an individual, you pay about $100 for a month for full medical care. You get a 7% dollar-for-dollar employment match, a $10,000 tuition reimbursement. If you have children, $275 per child per month. These are all benefits because we want our team to be able to focus on their career here and staying with our company a long time. And so we've raised them in response to some competitive pressures. We've raised them. We've hired 7,000 people in the first quarter. We aren't having trouble hiring people, but it's really to make sure we stabilize and have the best team that we can have.
I mean, that's fantastic, and it definitely means good things for your team. I just try to get to the broader issue of what this might mean and what it's going to take for people to be able to. I mean, real wages are dropping overall. If you look at the numbers, the inflationary pressures from CPI are eating away at any of the wage gains that people have gotten on average, not from your company, but on average. What do you think about this? Does it concern you to watch that?
Well, that's the question. So the labor market's tight, and you're hearing stories about our turnover moved up to where it was in 19 and about a little bit higher, but it's still well within what lower it was in like 17. So we feel good about it. But the reality is, when I talk to CEOs around the country, getting people is the number one issue. The labor market's tight. There's 2 job openings for every job. Going to some of that, real-time data, we've seen in one of our real-time data sets a little less job postings, which may mean the market's easing. But until that labor market eases, the rate of wage growth is going to be strong. And then the question is, can they slow price appreciation and let the wage growth carry through for real wage growth? And that's going to be big, especially with the market being down because it's held broadly in people's 401ks. That creates things. These are all impacts on people's view. The reality, though, is they aren't changing their behavior as of last week. In other words, travel in the month of May up 40% over last year. Restaurants up. Are they spending less at retail goods? Yeah, it's flattish a little bit up, but they're spending the money on experiences and doing things. So that's the conundrum, and that's because, frankly, a lot of them have the stimulus from before. So the real pressure point here, I think, would be as we move to the fall, unless you see some ease in the price appreciation and stabilization. So gas prices stabilize at some level, and other things that people, if grocery prices stabilize, then I think people really get much more concerned. Right now, it's competitive out there, and people are raising wages.
That there's still stimulus, meaning that you think that a lot of these bank accounts still have some of that stimulus money in them.
So for our account holders,
yep.
In April, if they had between $1,000 and $2,000 before the pandemic, they had an average balance of $1,400. They had about $4,000 in April. If they had an average balance of $2,000 to $5,000 pre-pandemic, they were carrying about $3,500. They're carrying $13,000 in balances. They haven't spent them down yet, and they grew 5% from March to April.
That's a remarkable statistic.
Yeah, remember, we have 35 million checking account customers, so I'm not giving you a little tiny sample. I'm giving you a sample of a broad base of households in America. So and they're all primary accounts. And we're even seeing, to Becky's point, in our employment checks deposited, our customers getting their, not our people, but other people, you're seeing their wages have grown 8% year over year. And so, when you look at all that, that stimulus still sits. The notion that people started spending down, it's been growing every month since last July. Will they spend it down? Probably, but not right now.
Another sort of Davosian question. Always a big conversation here about ESG, and lots of pledges have been made, climate pledges and other things over the years here. The question is whether that is a that was something that happened during a boom times. And what happens in a challenged economy, meaning all these companies that said we're going to do this, this, and this over the next 5, 10 years, we're going to spend billions of dollars. Do you think that changes? Do you think they say, you know what, actually I can't do that? Or activists are calling up and saying, no, you cannot, you got to cut this stuff out?
So I think we believe at Bank of America it's profits and purpose.
Right.
Not or.
No, I know.
And the key to that is we have to produce our earnings, $7 billion in the first quarter, and record earnings last year, and we have to produce. So when you think about it more broadly, think of the environmental commitments. We made our first environmental commitment in 2004. You think we went through some interesting times between 2004 and today, and it went from $25 billion to $50 billion to $125 billion to $350, and now $1 trillion, all financing our clients' transition. So what I think, Andrew, is where people will ebb and flow on this, given whatever the economic circumstance, the pace of things. The fear about energy drives more activity, maybe other things. The reality is if people have done it right, and the World Economic Forum here, the International Business Council, which I chair, has had these metrics we put out. 140 companies have signed on them, 72 are in their second year of disclosing. All those lay it out bare if you're not making progress, and people can see it. So whether it's women on boards, or whether it's diversity overall, or whether it's progress on environmental commitments, I think people will stick to them because they've aligned capitalism to achieving the goal. And by the way, these goals will not be achieved without the private sector doing it. The government doesn't have the money.
But let me ask you, you were very ambitious around climate and specifically around fossil fuels, right? In terms of what fossil fuel companies you would finance, what kind of projects you would finance. In this environment now where gas costs as much as it does, and people look around, and there's a question, was this the right call?
We finance oil and gas companies, and we finance green companies, and sometimes it's the same company. You know, that's the interesting thing, is even the oil companies have made major commitments to change and invest some of that cash flow. Is it the right call? In a spot basis, you'd say, we wish we had more oil, and you see in the production, the wells are coming up, and the production's starting to pick up here, I mean, in the U.S. and the Middle East and stuff, and that will happen because the demand will be there, and the price will be there. Of course, people are going to pump it. This is a transition. We have to have energy for everybody. We have to have all kinds of energy, and we have to build it. Meanwhile, we did $250 billion in financing last year. So during the pandemic, kept growing. It will do that much or more this year. And so our clients have made this. With the Sustainable Markets Initiative I work with, we just had the meeting in London a couple weeks ago. 100 CEOs in a room, all have commitments, all driving. It's part of how they're driving their business. It's not some commitment. It's not charity. That's what people have turned the switch from charity, which is terrific and wonderful, but doesn't give you enough money, to aligning their business. When they make a purchase commitment for sustainable aviation fuels, a purchase commitment for clean energy, or in our case, our commitment over multiple years to drive down our energy, our commitment with Duke Power to build a power plant, all these are commitments that are gone. I mean, they're going on. It's not like you reverse them because they're already working.
Bex?
Brian, real quickly, let's go back to the job market again. You mentioned that this is a situation where you think the job market could be easing a little bit, not quite as tight as it has been based on what you see with job postings. I mean, it's been an employees market for so long. This has been a take this job and shove it market. Do you think that is going to switch soon, or how do you read that? What kind of other things are you watching to see on that front?
It's not going to switch soon. So if you look at all those economists, including ours, they still have the unemployment rate barely getting to 4% or maybe 3.5, 3.6% at the end of next year. It's still going to be a very tight labor market, frankly, because in the U.S., because we don't have, we aren't getting more people. And now most of the workforces that pre-pandemic were at X are all back in the workforce except for young people. And so we got to pull them off the sidelines. The optimists say we can pull more people in and the participation rate will go up and the employment to population rate will go up. And you're seeing some signs of that. Older people, everybody said retired wouldn't come back. They did. They're back at the same levels they were before, older workers. So there's optimism there. But frankly, that's one of the challenges the Fed has is the unemployment rate is projected by everybody to be very tight in a historical context. And that then will make their job tougher because that wage inflation will be harder to tame. Goods inflation may come down faster, but wage inflation is going to be a tough nut.
Hey, Joe?
Brian, yeah, thanks, Andrew. Back to the ESG issue again. And in light of what we're seeing with some of the pushback against Larry Fink and maybe some of the other big money managers that are voting shares for their own preferences, it seems like, some of their own causes. I don't know if it's that much different for a CEO that might steer the company, your company, for example, in a direction that he has a personal opinion on. And I'm just wondering, do you ever worry about that? You're talking about a transition to clean energy, which may or may not have hindered financing for the fossil fuel industry in the United States. Now, that's coming home to roost, obviously. Where do you draw the line? Do you cut off gun makers? Do you Do you get involved with voting rights issues? These are all your own opinions as CEO, but it doesn't seem much different than what Larry Fink does, which is receiving a lot of pushback now. Should a CEO be able to steer his company in a manner that follows his politics?
Well, I don't follow my politics because most of you wouldn't even know what they were, and the company wouldn't know it. So we have 200,000 people, Joe, and they represent every interest. So we tend to take action when it means something to our teammates. But on the energy thing, I get a letter one day from people saying we're financing fossil fuels and we did underwritings for oil and gas companies. I get a letter the next day saying the opposite, you're cutting them off. And I went out with Senator Kramer out to Fargo, North Dakota, and talked to them about that. That state, has declared to be net zero by 2030 or 40 or something like that. They're building these huge carbon capture storage facilities. We're working with people on that to drive it back in the Bakken Shale. So there's going to be a lot of competing ideas and competing things here. But the reality is we drive profits and purpose, Joe, and that's how we run the company. And I'd simply say, if we did things that were good for our customers, you'd say that's fine. If you did things that were good for our teammates, you'd say that's fine. If you did things that were good for our shareholders, you'd say that's fine. If you did things that was good for our communities, of which a bank depends on its communities to be successful, to have customers, you'd say that's fine. That's what we do. And I don't think that's an unusual idea. It's an idea which has been around for a long time, and I did my first strategic plan laid out that way for a company in 1993 or 4 or something like that. These are not new ideas. So the politics are completely different from actually driving the company for what society needs and how capitalism can help drive the right things for things that are economic-based, are teammate-based, and things like that, and customer-based and shareholder-based. And that's what we do, profits and purpose, not or. It's called the genius of the and. And you could read my shareholder letter, and I lay it out. And I think, our shareholders are backing it.
Brian, before we let you go, got to ask, because it's a topic that everybody seems to talk about, Elon Musk. You guys are actually backing the margin loan that's going to allow him to either buy Twitter or not.
You keep asking people that, and they all say the same thing. It's not our deal. You have to talk to the principals to figure out what's going on.
You think it's going to happen?
You have to talk to the principals.
Let me ask you one other question related, though. No, but this is a fascinating question. Margin loans.
Yeah.
There's a big question about whether billionaires or anybody of great wealth should be able to use a loan that is not taxed and still create effectively that value. I don't know if you saw Trevor Noah created a sort of viral video about this goes to sort of wealth tax,
right,
and whether effectively money that we say is not really being used in any real way because it's not available actually does become available through a margin loan in this kind of context. What do you think about that?
Well, a couple of things. One is that's the way the rules are. You can have a margin loan. Joe can have a margin loan. You can have a brokerage account and borrow up to 50 cents on the dollar. That's what's given. So I think it's in for penny, in for pound. Either everybody can do it or not. The second thing is that money is used to do something that generates taxes. We pay taxes on the interest we get on those loans. And so I think it's a much more complex question than someone might understand just saying I can borrow money and not pay taxes. Because taxes are paid by other participants. The underlying assets they buy have taxes. If there's dividends, that's taxed as on a flow basis. Having been a lawyer a long time ago and studied taxation, it's much more complex than the average person thinks. So along all these issues.
Thank you, Counselor. Appreciate it. Brian Moynihan, thank you very, very much.
Shepard Smith here. Thanks for watching CNBC on YouTube.